after all my gaffing on stage about human creativity and supply creates its own demand, we're bringing you the leading supply-side investor in the world, Cathie Wood, to expound her theory of investment. This is investment that shapes the future rather than attempts to outguess it. And the only thing I'm worried about a little bit is that Cathie's so good when she's under fire that all this adulation may be not the best, bring out the best in her, but I'll do my best.
Thank you, George, and I'm really happy to be here. I realize this is an after-dinner speech, and I really don't do many of those. So here I'm equipped with slides, and you probably don't want to see a lot of slides, so I will go through this quickly. But I'll start out by talking about why I started ARC. It was to address some of the things I heard discussed up here. I feel as though the financial world has lost the plot, and I feel that investors, especially after because of the tech and telecom bust, and then even more so after 08-09, have become extremely risk averse, and so much so that they are investing in the past. So what we're seeing is investors and analysts worrying about whether they will beat their benchmarks. Now, benchmarks are there because these companies have been very successful over time and they rise to the top of benchmarks. One of the reasons I started ARC is because we have never been on the threshold of as much disruptive innovation as we are today. And yet this shift into benchmarks is more about, as I said, investing in the past. So ARC is all about the new creation. I feel that we have witnessed in the last 20 years the most massive misallocation of capital in history as funds have really evolved towards these benchmarks. And it is during a period of risk off that we saw during 21 for innovation and 22, fear of interest rates rising in 21, and then the reality of interest rates rising in 22 absolutely destroyed assets of long duration. And I don't mean just stocks. Long duration includes long-term bonds as well. So last year, we had the worst bond market in really history since the 1700s because the Fed jacked up interest rates 22-fold in roughly a year's time. This has never happened in history, and I think it has been very destructive in that it has pushed investors even closer to their benchmarks. So they are buying Apple and the FANGs and the Magnificent Seven, and they are selling the stocks of companies that are innovating and creating the new world. Now, I say to my team, and Dan White, Associate Portfolio Manager on my team, I always say truth will win out. And the forces that this 22-fold increase in interest rates have set up, I think are going to move in the opposite direction and are going to reward long duration assets like long bonds, but also like innovation-based strategies, pure play innovation like ours. Let's see, so Big Ideas 2023. We do a Big Ideas every year. And of course, big ideas don't change very often. They become more understandable, actually. We think that, as I mentioned, we're at the threshold of the most disruptive period for innovation, or caused by innovation, that the world has ever seen. And the 14 technologies that you see here are the reason why. Now, you can see those technologies, and we can talk about, George and I can talk about them afterwards. But these 14 technologies are involved in these 5 platforms. So these are 5 innovation platforms evolving at the same time. This has never happened in history. The closest we've gotten to this is the early 1900s, when 3 innovation platforms evolved at the same time. Back then, it was telephone, electricity, and the internal combustion engine. Completely transformed the world. Today, we're talking about these 5, and the biggest catalyst in terms of all of these innovations is artificial intelligence. You can see it at the center here. So the 5 major platforms are robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing. We have, in the last 20 years, we were fighting in the financial markets. Now, I know a lot of you are in the venture world, you're entrepreneurs, and you may not relate to this, but what we are fighting in the public equity markets is this notion, and have been fighting, that exponential growth, rapid growth cannot be sustained. And that is because we've been in a linear growth world for so long, where you do have a burst of activity, and then it decays down to the GDP growth rate. In the tech and telecom bubble, we first heard the expression exponential growth. Growth sustained, say 20 to 30% growth sustained for years. And many people thought that was going to happen. And that's how we got the tech and telecom bubble. We had too much capital chasing too few opportunities too soon, and it ended badly. Now, the seeds for these 5 major innovation platforms were planted during the 20 years that ended in the tech and telecom bubble. And they have been germinating ever since. They weren't ready because the technologies were not ready during the tech and telecom bubble. We didn't get the cloud until 2006. We didn't get deep learning out of ImageNet until 2012. We didn't get the other big breakthrough in artificial intelligence, transformer architecture, until 2017-18. We were not ready for prime time back then. And even if the technologies were getting ready, they were far too expensive. So the first whole human genome was sequenced, or shall I say most of it, we thought it was the whole human genome, in 2003. It took $2.7 billion just to sequence one person's genome, $2.7 billion, and it took 13 years of computing power back then. Again, the technologies really weren't ready, and if they were even close to ready, they were far too expensive. Today, DNA sequencing, remember I just said it took $2.7 billion 20 years ago to sequence one person's genome. Today, it takes less than $500 and just a few hours of computing power. So again, that's a really good example of back then, too much capital, chasing too few opportunities too soon, right? Investors were chasing the dream. Today, where are we? As I just mentioned, the tech and telecom bust, and then again 08-09, has scared investors to death. And so here these technologies, again, the seeds were planted back then, they are ready for prime time now, and investors are running away. They're running for the hills. What are the hills? They're benchmarks. It does take a lot of fortitude. As George said, I'm probably at my best in front of CNBC, who you all hate. But they do not understand that ARC is the closest you'll find to a venture capital fund in the public equity markets. And they truly do believe that rapid growth leads to inflation. And if you look at the history of the last 40 years, that has been absolutely untrue. You can see the numbers. They're just not looking. They're very Phillips curve, very Keynesian in their assumptions, and they're just wrong. So here are the 5 platforms, and I'm going to go quickly through this presentation, understanding it's after dinner, and this may not be as entertaining as most after dinner speakers are. But anyway, convergence. So this idea of exponential growth, finally, it did get some respect. We do have a poster child, actually from this city, Amazon. Boy, were we fighting battles back in the early 2000s as we were going through the tech and telecom bust and then coming out of it. Nobody believed that Amazon could grow revenues at a compound annual rate of 25% per year on average for 20 years. And we were fighting that battle and fighting that battle and fighting that battle, and it finally paid off. But boy, back then, even when indexes weren't as powerful in terms of an attraction for investors, it was really hard to convince investors that we would see such exponential growth. Well, we did, and some people now do believe it's possible. What we are saying now is that we are going into a super exponential growth world, because those 5 major innovation platforms around which we have centered our research and investing, they are converging. And so what we have are the equivalent, so all of you in the innovation world understand what an S-curve is. You know, start out slowly and then you get into the sweet spot. Well, what we have now are S-curves feeding S-curves. They're feeding each other, and we think creating explosive growth opportunities. And you can see that from the purple here, that AI, which touches almost every other technology on this sphere, that it is the major catalyst. We're putting a paper out, I think it will be later this month or early December, on this concept of convergence. And Brett Winton, who's our chief futurist, has actually analyzed which of the technologies are the biggest catalysts for other technologies. It's a scoring system, which I definitely will not bore you with tonight. But you can see at the bottom there, it is, and you can also see from the depiction here, it is the most important of these technologies in terms of catalyzing other technologies. Which are the biggest beneficiaries of these technologies, these 14 technologies, of this idea of convergence? We think it's autonomous taxi platforms. So autonomous taxi platforms involve the convergence among 3 of the major innovation platforms. Robotics, autonomous vehicles are robots. Energy storage, they will be electric as the learning curve associated with drivetrain technology plays out, and electric vehicles become much less expensive than gas-powered vehicles, and artificial intelligence. So 3, robotics, energy storage, and artificial intelligence. So let's talk about learning curves to get a sense of the drama here. I'll give you a few of the 5 major innovation platforms. There are some stunning learning curves evolving here. If you look at industrial robots, the learning curve, so as George mentioned, Wright's Law, we've centered our research on Wright's Law, and the biggest surprise to me in the investment world, period, not just in the public world, but in the private world, is that others are not doing this kind of analysis. Most people in the public investment world do not know what Wright's law is. Wright's law is a relative of Moore's law. Moore's law is a function of time. Wright's law is a function of units. Now that the semiconductor world has slowed down in its cadence, it's kind of hitting a wall, Wright's law is getting the semiconductor forecasts right, or is doing a better job at forecasting what's going on in the semiconductor world than Moore's law is. Wright's law says for every cumulative doubling in the number of units produced, costs decline, costs associated with each technology decline at a consistent percentage rate. So in the world of industrial robots, again, we've centered our research, we're doing this research, we give it away because we think there are such inefficiencies in the investment world around innovation, definitely in the public marketplace. So what's the learning curve of industrial robots? 50%. Now, this is why technology is extremely deflationary. We hear all this talk about inflation going on, and I just wrote a tweet, just put up the Bloomberg Commodity Price Index from 1980 to today. It hasn't gone anywhere. We're at the same place, and everybody's talking about it. So I actually think, for those of you who have studied economic history, that we're probably closer to a Kondratiev wave on the downside than most people understand right now. And helping it along are going to be all of these technologies. So that 50% decline in industrial robots. For drivetrain battery pack system technology, that number is 28%. That's why Tesla can cut its prices and still be profitable. And I think the auto companies are baffled because they're saying, well, we can't produce these electric vehicles profitably, so we're not going to do that because their shareholders don't want them to do it. I don't know what's going to happen to them. All I know is this gives Tesla more room to run because the competitors are starting to back away. In the multi-omic sequencing space, or DNA sequencing specifically, that learning curve is 40%. Again, a 40% drop in costs for every cumulative doubling in the number of whole human genomes sequenced. And we're at a very low base, so we're going to see many cumulative doublings. And we're already down to $200 to $400 in DNA sequencing costs. In the case of artificial intelligence, the data metric here to compute Wright's law is it's a relative compute unit, and it involves a metric involving data per compute unit. For every cumulative doubling in that metric, costs decline by 48%. Now, the showstopper here, or the aha moment for us, was, okay, we did that, but AI training costs, when you combine both hardware and software, are dropping 70% per year. So what does that mean? The cumulative doubling is taking place in less than a year's time. That's why what's going on today is so provocative. All right. Here are just some examples. We know that, we didn't know it actually, but it did take transformer architecture for Tesla to begin to believe truly that it was going to be able to complete the last mile in autonomous driving. So these are just a few of the convergences. This is DNA sequencing 60% more accurate because of the convergence between DNA sequencing and artificial intelligence. Again, this is in our big ideas. You can look up the details. yes, this is robots and the convergence of robots and artificial intelligence, and just how much better they perform, whether they've done tasks before, but especially if they have not done tasks before, given this convergence. Battery advances, so just 3 times the battery capacity. This is since the iPhone, 3 times the energy density. And now we're talking about Meta Platforms, Ray-Ban smart glasses. So our analyst and also assistant portfolio manager Nick Gruss bought some of these glasses, went golfing, I think with Dan, if I'm not mistaken, and had these glasses on all day. They didn't run out of battery power. Now, they did need a 10-minute recharge every once in a while, but he was taking pictures of them playing golf all day, and it didn't run out. Could not have happened without the advances in, oops, sorry about this. Yes, reusable robots. Here we just give the example. If you remember in the tech and telecom bubble, Iridium was one of the poster children of that age. And you can see how much a phone cost and how much more expensive it was per minute compared to terrestrial phones and minutes. And it was uneconomic at that time and, of course, went bankrupt. Today, the combination of T-Mobile and SpaceX has collapsed that altogether. So pretty exciting there. Cryptocurrency, so what kind of convergence there? We worked with Square or Block a couple of years ago on a report which showed that if you incorporate Bitcoin mining into a utility ecosystem. So think about this. This is convergence of battery technology and Bitcoin in this case. What you can do is overbuild solar and wind, because what are we dealing with in that utility ecosystem? Huge battery storage systems that, in the case of Florida, they fill up. The sunshine is wonderful in Florida. They fill up, and then the energy would be wasted beyond that. Instead now, that energy is being allocated to Bitcoin mining and earning utilities more money so that they can overbuild solar and wind. So another convergence that wasn't obvious until we faced the environmental question of Bitcoin and all the electricity that it was using. Now there is a sustainable element to this ecosystem. GDP growth. As you can see from this chart, through history, technology has caused leaps in GDP growth. And you can see from, I think it was 1400 to 1900, or 1500 to 1900, the world was growing about 0.6, this is real GDP growth, 0.6% per year. And then those 3 platforms I mentioned earlier, telephone, electricity, internal combustion engine, of course, transistor, computers, internet, then that catapulted us into a 3% GDP growth world. The consensus view going forward is that GDP is going to downshift. We completely disagree. And we believe that we should see a greater growth increment than we saw in the period, in the last period. So that was 5-fold, which would take us to 15%, but we didn't want to seem completely crazy. So we put 8% out there. But, you know, it doesn't make any sense that GDP growth should slow down given all of the innovation that is evolving right now. And the other thing that makes no sense is that inflation will remain a problem. There are two camps right now on inflation. One, And many of you, Stanley Druckenmiller has been interviewed a few times, so you've probably heard him on Bloomberg or CNBC, beloved CNBC. And he's very much in the higher for longer inflation. We're in the 70s. This is intractable. Look at the wage negotiations, the UAW, the auto companies, the airlines, 10% per year, 6% per year. And our answer to that is many of these industries are going to be disrupted, disintermediated, and perhaps destroyed. And so what will happen is that those wage gains will end up crushing margins. This is not going to be pushed through into inflation. If anything, we believe that we're going to enter a period of deflation. Now, I know deflation sounds scary. It sounds scary because of 08, 09. Everyone was talking about a deflationary bust back then, and it was horrifying, and it was terrifying in many ways. Because there was almost a complete financial meltdown. That's not what we're talking about right now. There's good deflation and there's bad deflation. I just gave you an example of what bad deflation will be. Companies that have not invested aggressively enough to move into the new age, and they're going to be disrupted, creative destruction. The good deflation is what I described before. Those learning curves causing cost declines, which are passed through to prices, which will cause booms, absolute booms in these technologies and in productivity. And the virtuous cycle that we're going to see is going to be astounding. Now, many of you know that CNBC has called me Crazy Cathie. And you may think that now too, but we really believe what I just said because we're doing the research. We're doing the research that very few people out there are doing because they just don't believe it. They don't believe it. And they also don't believe you should do much from the top down. And that became a kind of the mantra as I was growing up in the business. In the old days, most portfolio managers had macroeconomic backgrounds, and they did think top down. Then we went into this bottom-up world. You can't think top down. That'll get you thinking crazy thoughts like this. And that's why there is the psychology out there. But I believe that truth will win out. And, we got our first taste of this. We've gotten two big tastes of it. And JD, Steve's son, is in the audience, I believe. And during the pandemic, a lot of young people were stuck at home, and they discovered the stock market, and they discovered ARC, actually, that way. And we were talking a lot about Bitcoin and Tesla and innovation generally, but those two really resonated with the young people. And we couldn't, and they ended up performing spectacularly because this concept of, in the case of Tesla, super exponential growth is starting to play out, especially now that other auto manufacturers are pulling out, and because of all of the advances in AI that are going to take it into the autonomous world. And in the case of blockchain technology, and this is where I'll end, I met George through my teacher, professor at USC, and mentor, and now dear friend, Art Laffer. And Art is 83 years old. And in 2015, we asked Art if he would co-author or just collaborate with us on a paper having to do with this thing called Bitcoin. And he reserved judgment until he read the paper. He read the paper, he was quite intrigued by it, And he tore it apart, as I expected him to do, and said he would put his name to this and not to that, not to the technology part, but to the economics part. And we really do believe that Bitcoin is, and each one of these words is important. It is the first global, private, no government oversight, rules-based, critical, rules-based, digital monetary system ever. And it's a very big idea. We think that the entire crypto asset ecosystem, and we think most of the crypto assets you have heard about out there, will disappear. There will only be a few for different reasons. That ecosystem in 2030, we think, will be a $25 trillion ecosystem. Right now, it's a little over 1 trillion. We think that the biggest idea out there is Bitcoin. And so I'm going to end in the public and private equity markets today. We believe, according to our estimates, truly disruptive innovation is valued globally at, after the setback this year, probably $12 trillion. We believe that is going to scale to $200 trillion in the next 5 to 10 years. And one of the reasons is the reason is the 5 innovation platforms evolving and converging and creating super exponential growth in those technologies, but also in the real economy. So,
You know, time prices do vindicate all your assertions.
thank you. Could you come and talk on CNBC and educate these people?
We are in an age of superabundance, and we have been for 30, 40 years, and time prices demonstrate it, and it's there's been you were saying that commodity prices are flat since 1980, measured by time prices. Commodity prices are down 75%.
Absolutely. But one of the reasons I've featured that particular chart and put it on Twitter is, you know, to question the people out there who are saying we're in this 70s style inflation. Yeah. Actually, so in real terms, you're right. Those prices have collapsed. In nominal terms, they're flat. Yeah. That is not the perception. People think we're in this massive inflation. Yeah.
We have another technology that's just as massive in its impact as any of the ones you cite.
Let me guess.
And this conference has been been celebrating it with all sorts of cogent speeches, and that's graphene.
Can I?
A two-dimensional.
Yeah, and because.
And it confirms all your 5. It strengthens all your 5 different converging technologies, and in fact, will make them possible.
So we, Universal Matter, we're looking at it. We've just actually started a venture fund. So we are very interested in these very early stage material science. So just to throw maybe just a little bit of investment experience into the discussion. Yeah. Right now it reminds me a bit of nanotechnology in the day. And I remember we were chasing it down, and what happened to it? What happened was the big industrial conglomerates bought up all of those companies, those small companies, and they were the biggest beneficiaries. The other thing, I mean, we have studied material science. It's hard to scale. That's the biggest thing. Yeah. And then the third thing is, our biggest mistake, I think, in the last 10 years, so we'll be 10 years old in January, in terms of assumptions for a technology, is 3D printing. And when you're dealing with the aerospace industry, automobile industry, the regulatory environment is so exacting and frustrating. One of the biggest sources of hope for all technologies that face regulatory impediments that really shouldn't be there, some should not, is regulatory arbitrage, meaning China or some other country competing, Israel, and innovation solves problems, so hopefully, that will kick in over there as well. But this regulatory arbitrage is becoming very important. I think we've been put to shame in this country on the whole blockchain technology, especially Bitcoin world. I think that's very political. So we've got to get politics out of this.
Well, I've been rethinking Bitcoin a bit in view of the radical deflationary forces that are manifested by time prices. Bitcoin's deflationary properties, its cap, may not be so crippling as I've imagined. And it gives it an additional impetus that real prices are actually dropping as fast as the Bitcoin cap reduces the supply, so the rate of growth of the supply. So Bitcoin has a shot still, but I think there's going to be other, Bitcoin will change, or there will be some evolution that can make it the real money, that all fiat currencies will be ultimately valued by their time prices registered in Bitcoin as it evolves.
So when Art looked at the paper in 2015, so this was in 2015 when Bitcoin was $250. It's at $35,000 now. The first response he had was, I've been waiting for this. I've been waiting for this since we went off.
Whose response?
This is Art Laffer saying,
Art Laffer.
Yeah, I have been waiting for this since we went off the gold exchange standard in 1971. I have been waiting for this, a rules-based monetary system. Now, I don't think it's the right rule, he said, meaning it's a quantity rule of money. Yeah. But they'll get it right. Now we've done 2 more podcasts with him, and as I mentioned, he's 83 years old.
So by the way.
All right, God bless you. God bless you. I have never, and innovation keeps us all young, right? So he's like a kid. I have never seen him more excited because he said, we have a chance of getting the Fed out of the equation here. We have a chance, yes, of going back to private money. And he also said in our podcast, let's see, I think it's I don't know, it's a number of our podcasts, but Art Laffer, Bitcoin, and you'll find he said that there is a way, and this is in answer to one of the questions up on your panel, there is a way that with the institutionalization of Bitcoin, that and bringing a lot of decentralized players into this, that it will evolve into a price rule by its very nature if it becomes big enough. I remember saying to him, this is when it was $250, so it was a $6 billion market cap. Today it's $500 billion. I said to him when he said, I said, Art, this sounds like a big idea. And he said, it is. And I said, well, how big is it? And he said, well, how big is the U.S. monetary base? And back then, it was $4.5 trillion. Today, it's $8 trillion. It's a very big idea.
Yeah. Well, that's... So, Art... do you regard yourself as a supply-side investor?
Yes, I do.
Yeah.
Supply creates its own demand. The
Yeah.
new creation, absolutely.
Yeah.
And I'll also tell the story of the first time I met you. The first time I met you was in 1980, and no, you wouldn't have. I was 20, early 20s, just moved to New York, and none of the portfolio managers could attend this dinner, and you were there, and we wanted representation there, so they gave me my first shot, and the first dinner I ever went to, professional dinner, was you, and I was blown away, and I was the only.
Yeah, when was this?
I was blown away because I got into the business for reasons that you were talking about very freely that night. I got into the business. I first started at Capital Group on the West Coast because I thought, wow, all of these people are being paid to learn, and not just and to learn about how the world's going to work, and and you were talking about the future and taking people, to a place in time where they weren't used to living, and I loved it. I loved it.
Okay, well, and how did I miss you? But anyway, well, that's terrific. What are your how do you plan to change your investment company? How is it?
Yeah.
How will it respond to all these convergences? Your own entity.
Yeah. How are we going to try and avoid being disrupted? Because the traditional financial world is going to be disrupted. Well, we think, and if you're talking specifically about the financial world, we know that we have to insinuate ourselves into the digital wallet world. We think individuals are going to run their financial lives through digital wallets. WeChat Pay was the earliest version of that. I just listened to Block's earnings call today. That's what they're going to do. So we need to find our way into all of these digital wallets. In terms of ARC generally, we're starting crypto funds. We just started a venture fund, but we are trying to be true to our brand and our roots, focus exclusively on disruptive innovation. That's true. Very transparent. That's not true of the traditional venture world. Very transparent and crypto world. And we're focused on democratization. So we not only give our research away, so we have a social media, social marketing, and now we have a social distribution strategy. So our venture fund can reach people through an app, the Titan app, and they can get involved with our fund for only $500. So young people, and that's the biggest question that we get. Yes, and so we're thrilled with the holdings in the fund right now. I think that our willingness to give away our research, which has become part of the decks in a number of venture capital companies, has given us a place at the table more than I thought it would, and I'm very grateful for that.
You deserve it.
Thank you.
One wild card question. Charlie Munger said yesterday that BYD in China was outperforming Tesla in manufacturing and was making greater gains, and that he really was ready to bet on BYD against Tesla.
Well, they've had BYD in their portfolio for a long time. And there is going to be a Chinese champion. The government will have, Tesla is not going to be the Chinese EV champion. Tesla can be the big exporter of a very high-end product, which they want. They don't want to just be, low-end commodities exporter, right? So They're quite pleased so far. And BYD has done a great job. You know, BYD's success is part of the reason, or the reason they've been so successful is the same reason Tesla has been successful. They both decided to leverage the consumer electronics learning curve, right? Whereas most other automakers did not believe you could use cell phone or laptop batteries and line the bottom of a car. They thought that was a recipe for fires and, you know, disaster. And of course, those are the two companies. Well, no, they're starting to change their spot. They have to change their spots because their learning curve may be steeper, but their costs are starting from a much higher place. Yeah. So I think BYD and Tesla are the two to beat. Yeah. I don't think I think those two are the share gainers, the major share gainers during the next 5 to 10 years.
Well, thank you, Cathie.
Yeah, thank you, George.